Welcome back, guys, to another roundtable. My name is Adam. I have Bruce Smith.
Hello.
Victor.
Hi everyone.
Today we're going to discuss the three-fund Boglehead portfolio. So this is a pretty famous way of investing. It's by John Bogle, the founder of Vanguard. And we're going to discuss how you can use this for yourself if you're interested in this kind of like strategy to invest over the long term for retirement. And you just need to invest in three funds. And then we're going to talk about what kind of funds and how we can tailor that for people who are living in Singapore or somewhere else outside of the US as well. All right, so maybe just really quickly, what is this three-fund portfolio?
Okay, so this one again came out by John Bogle. He's the founder of Vanguard, all right, and they are pioneer in index investing. So that's why people call him the father of ETFs, right? And when they first introduced this concept that allow investors to usually invest in ETF, that one ETF alone you can actually own thousands of companies, and that was actually quite a revolutionary thing. In the past, the only way that you can invest in this type of fund is through mutual fund, where the fees are usually like 1-2%, right? But that's why ETF, when it was being created, and the fees that they charge is like 0.023%, right, which is extremely low, and that's why make index investing become very popular today, right? So John Bogle actually introduced this three-fund portfolio, where basically he recommends investor to just invest in these three simple funds, right? So the first one is basically, I think he's referring to Americans, where you should invest in the total domestic fund, okay, which we call it like Vanguard Total Stock Market Index Fund, right? This index itself today, it owns about 3,700 over stocks that are listed in the US. Okay, most of them are domestic company, and that will give them immediate exposure to tons of company that is diversified across different company, different industry, right? And you don't need to pay a tons of fee on that, right? So, and you basically get to enjoy the growth of US economy through this bunch of companies. So that's one fund that he actually recommended. And the other allocation that he also suggests people to really invest is to outside of US, right? Which is they call it the Vanguard Total International Stock Fund, right? So this one actually invests in 5,000 over companies that are outside of the US, either in the developed market or developing market, right? So it's very diversified, but he suggests to stick to like around 20% of the portfolio, right, that invest outside of the US. So you get to enjoy in the past, higher growth from these other countries. But it turns out that the domestic fund, the US alone has done a lot better. But that US portion, he also recommended at least 50 to 60%, right? So that percentage is really depend on the investor at the end of the day. But this is one of the these are the two funds that he suggested. And then of course there's one more fund which he suggests investors to put in. It will be like the Vanguard Total Bond Market Index Fund. Okay, so this one really invests in those T-bills, mortgage-backed securities, and most of it, if you look at it, it's actually 67% is actually owned by US government, and then the rest are like AAA, AA rating, right? And then BAA rating, or investment grade kind of bond. And that 20%, the idea here is basically to give you that cushion, right? And it's a lot safer when you invest in bond fund versus individual bonds, right? Because you are like big quantum concentrated in one stock versus a lot of bond funds in this single ETF. So this is basically what they call it, like Boglehead's three-fund portfolio, just the three simple ETFs. And the fees that they are charging, I think for total stock market index fund, which is the purely on US companies, is only 0.04% expense ratio, and then the international stock is about 0.08%, and then the bond fund is about 0.03%. So it's like very low cost.
So it's kind of like spreading your bets across, I guess many
close to 9,000 over companies.
And then in the bonds as well, to give you some sort of like income as well. So that was in an American context. So for someone else, like for us, we live in Singapore, or maybe you live outside of the US, wherever you are in the world, then I think the question would be, so does the same strategy still apply? So for example, John Bogle said buy US because he's US, he's American. So would someone who's living in Singapore, for example, we are living in Singapore, do we buy 60% domestic, in local stocks,
ETF.
Singapore stocks, at the STI, for example, and then you do the international, could be international or US, and then of course you have your bonds. How would you actually tailor this toward someone who's living in Singapore, for example?
Yeah.
How would you do that?
Don't buy STI ETF.
Okay.
I mean, the performance is not fantastic, and our home country is small.
Okay.
I think that's much bigger. I mean, we as a Singaporean, we also know, even though we are Singaporean, but then a lot of things quite international in Singapore also.
Yeah, unless one day Singapore becomes a Silicon Valley where a lot of innovations are happening.
Oh wow. Yeah.
Then
Okay.
you may shift higher concentration back to Singapore.
But so I think as a whole, you should invest in like global, right?
Okay.
So the first one, they say total stock market index fund, which is the domestic one. I will switch it to VWRA.
Okay.
Right. So the VWRA itself already contains 3,000 over stocks, 3,600 plus, and it's not only in also cover the US, 62% US, and the rest are all like large and mid emerging and non-emerging markets for the developed or non-developed markets for the VWRA.
Yeah.
So I feel it covers all ground. You don't need to even invest in the international stock market index.
So basically, VWRA covers
Should be 90%.
domestic and international equity, basically.
Yeah. Then your bond 10%, you can just use your CPF,
Mm-hmm.
right? Which the SRS give you 4%.
SRS.
Sorry, SRS.
The CPF SA.
Singapore
SA,
Yeah,
sorry.
it's a
SA
special
give you
account.
4%, right?
Yeah.
Yeah.
Right. So I think this strategy makes more sense because even though John Bogle says this strategy, right? But if you look at Warren Buffett,
Mm-hmm.
he said the event he passed away, it will be 90% in the S&P 500 and 10% in the bond fund.
Mm.
Right? I feel you should concentrate your power in the stocks, right? Instead of spreading too much, because after all, you will feel like it's like duplicating each other,
Okay.
right? So that's why I say the 90% should be in the VWRA, because it covers the US and it also cover international. Okay, but of course, if you look in terms of the returns, right? I went to calculate the FTSE All World ETF, which the VWRA track, right? For the past about 30 years, the CAGR return, inclusive dividend reinvestment, excluding all those transaction costs, is about 8.25%
Per annum.
per annum.
Okay.
But if you do back for the S&P 500 gross return, same period of time, 30 years, it's about 10.5% return,
Mm.
Yeah.
right? Dividend investment.
So basically, the US has outperformed
Correct.
emerging markets and stuff like that.
Yeah, and also I went to see, okay, is it one off now? So I went to do the 88 years returns for S&P 500. It's about 10.8%. So I think S&P 500 dividend reinvestment, I think it's around there, 10%.
Okay.
Right.
Okay.
So then again, there's some alternative perspective is that you see your VWRA got 62% already in the US, right? The other 40% is outside US, which is quite well diversified, right? Some people think that, if US market, because they buy VWRA is because they want to buffer in case US is not superpower, anything happen to US or the whole US collapse, you still got other countries that you own,
Okay.
right? But then there's another saying is that if US collapse, everywhere also collapse already,
Okay.
right? So make sure you buy.
Just focus on the US.
Just focus on US, right? So
Yeah.
so you can do that also, but as a Singaporean, you should buy the Irish domicile, right? Either CSPX or VUAA,
So if you were to focus on the US, it will be S&P 500.
S&P 500.
Yeah.
Okay. Alright.
There's another alternative. Let's say if you don't want the Vanguard All UCITS ETF, right? You can look at iShare Core MSCI World UCITS, also the Irish based on normal style ETF, right? So this one, they own about 1,400 over companies, so slightly about half of the number of companies that Vanguard own. And the fees, the total expense ratio is about 0.2%, slightly lower than 0.22%, right? But which is very negligible,
Yeah.
right? And they own about 70% in US, close to 6% in Japan, UK, 3%, 4%, France, Canada, they're about.
So it's
3%
similar to the
Switzerland.
VWRA?
It's very similar profile actually, right? So this is one alternative that
Okay.
if you somehow don't like Vanguard.
Okay.
In case, we are not paid by Vanguard to do this roundtable.
Yeah.
But these are some of the low cost ETF that you can really look at, and then you get with just one ETF, you get domestic exposure in the US and then the international market exposure right away.
Okay.
Yeah.
So this is one alternative, right?
And it's accumulating, right? This one.
It's
Yeah.
accumulating.
Yeah. So the index the ETF that we share is accumulating. So they help you do dividend reinvestment. You don't need to do it
Yeah.
yourself.
Okay.
But again, the thing about ETF strategy is that for it to work really well, you have to hold on for the long term. Go through the ups and downs of the stock market, right? So like what John Bogle said, right? Stay the cost, right? Because if you give up somehow, if there's a market going to crash, you listen to some jokers say the market going to crash, you cash out during the downturn, you might miss out the whole. Now that defeats the purpose of index investing. You have to stay invested and then do your maybe monthly, average buying, dollar cost buying. So this strategy for ETF again is very, very important to hold on for long term. And there's also because what we see, the past performance that Victor shared with you is that doesn't guarantee the future success. Past performance is not indicator of future performance, right? That's what they always say in the ETF. So it boils down to how the market move, how the world moves in the future, right? Whether US economy will continue to be the biggest economy in the world. If they are, then this strategy will give you market rate kind of return, right? But for a Japanese, right, for example, if you are buying to a Japan ETF, you think that domestic should like 50-60% Japan ETF. For the past 30 years, you will not do so well, right? Because Japan economy didn't go that far, or has been struggled. They have like lost 3 decades until recently started to like almost break even the Nikkei index, right? So this is the downside of ETF. You are betting on the US economy, right? If you are putting a huge chunk of the allocation in US stocks, then you are betting on the US economy. You are putting some on China, right? Then you are betting on Chinese economy. You are putting in Singapore, you are betting on Singapore economy. So that's how the way I see it. Because ETF is literally give you like a bunch of companies in that particular market. So that will give the GDP performance in the future of those countries will impact those performance at the end of the day.
That's why you buy the world index. If the world down, then you down.
Correct.
That's all.
That's what
it
it is,
makes more
right?
sense.
Yes.
You don't rely on just the single
ETF.
country only.
Right. Okay.
So of course, then the question comes. Okay, so there's a bond component. How many percentage you should get, right? So John Bogle suggested 20%, but I think based on research, if you let's say all in stocks, for example, I think there's a research done by Vanguard. I think from 1926 to 2015. It's a bit dated, but I think that amount of data that they use is really quite significant. So if you put 100% stocks, okay, you must remember basically 0% bond, right? You must remember that your stock you can achieve like 10%, 9% kind of CAGR return, based on past performance, right? But in some years you may experience a drawdown as much as 43%. That kind of volatility that I'm talking about, you have to stay on to the cost, okay? But if you don't want that kind of so much volatility, you don't mind lower return, then obviously there's this also very popular rule where they call it 60-40 rule, where it's more a balanced portfolio, and that will give you lower return, about 8.7% CAGR, and the worst single year return they will experience is 26% drawdown, based on the past.
Because it's buffered by the bonds.
Yes. So but of course this 60-40 rule didn't do so well in 2022, and people thought it's going to be dead, right? Because it experienced a down of like 15.8%, because the bond portfolio also down, right? So the whole idea of having bond is really to serve that buffer, right? In the event when the stock is down, the bond will be up, because people will switch their investment in stock to bond, because it's a lot safer, and bond prices will go up, okay? But that's theoretically speaking. In actual fact, like what we saw in 2022 during the hyperinflation, bond also dropped, bond also dropped. Okay, so but this 60-40 rule portfolio is also, I think, it's like industry standard.
Okay.
Like what is
so the rule of thumb?
Rule of thumb, I can say it. Like, but at the end of the day, it boils down to you, right? If your risk level are more higher, you can go for 100%. Right? If you are more conservative or somewhere in between, you do 20%. If you're more conservative, then you put 40%.
All right,
Depend on your age also.
So I think this is one of the things that we as Singaporeans have an advantage because of CPF.
Right?
Because it's 4%. No matter what.
Where can you find it?
For now, touch wood. I mean, 4% risk free, and it's different from like a bond ETF where prices can go up and down because of interest rates moving and all that. If you put in a CPF, it doesn't move. You just get that 4% special compounding as well. So that's one of the things that we have. I think so. You don't really need to buy a bond ETF as a Singaporean, right? You can just use the CPF as your
just top up your SA account.
SA account, max it out,
8,000 a year and stuff like that. To enjoy tax benefits and stuff like that. And if you were to do that, because since you're already if you're earning a salary, and you're like contributing the cash top up. So you're really like building your bond portfolio.
Yes.
Anything left over, just 100% stocks basically.
Yeah.
Because overall your whole
Oh,
wealth is still
yeah.
split between the two.
I will do that lah. If
You
I,
can-
if
yeah,
I
of
just
course.
purely ETF.
I still like to have liquidity. on
I
a
mean, of
personal
course, you
level.
have, yeah.
Right, so I will still consider SSB Singapore Saving Bonds, even though have a lower yield, less than
Mhm.
but then now it's about 3.3%, right?
Yep.
I don't mind that, right?
Mhm.
Because I can that CPR once you put in, you have to wait until like
Yeah.
what?
I think you do
55,
that if
55.
you max out your SA account.
Yeah,
Yeah.
But
max
if you,
out
if you
the
haven't
account.
maxed out yet,
Yeah.
Yeah, but even if I haven't maxed out my SA account, I will still want to go for the SSB because one day I may never know that I will need that 50, 100,000 or 200,000, immediately. So SSB, I can just click the button, withdraw. Within a month, I get it.
Okay.
For SA, I have to wait until like
yeah.
55,
yeah.
But of
Still
course,
young.
because now you are, let's say, because
Yeah.
the SSB is
High.
3+%,
Yes, yes.
But in the past, it's not like that.
It was
right?
1%,
Yeah,
it wasn't
yeah,
like that,
yeah.
1%.
So now you can consider SSB. But if it's the rates start to drop, then obviously SA will stand out again. Yeah, if the spread started to become like 2%, yeah. So I think that makes sense again.
Yeah. Okay. So I mean, like I said, I think that's the advantage that we have because of the CPF scheme that we get to
Yeah.
enjoy.
Yep.
And you just like the liquidity, the flexibility that comes with the SSBs.
SSB,
Yeah, Singapore Savings Bonds.
Yep.
So you can just take it out anytime and invest it in the stock
Yeah.
market because that's
Because-
your intention there.
Yeah, that's the purpose of bond allocation in the portfolio. That's the
Okay.
idea. Yeah.
So actually, you're using SSBs as liquidity rather than a bond portfolio. It's not really like a
yeah.
bond portfolio for you. It's
It's
a
just
temporary thing.
maybe the place where I park my emergency fund.
Yeah.
Yeah.
Okay. So it's different from like a
Total-
long-term permanent bond
Yeah,
portfolio,
yeah.
right? For you.
Yeah.
All right. But I think that's the advantage that we have. I mean that's what I would personally do myself.
Yep.
If there's anything that I want to put in bonds, I just put in the CPF until it maxes out, and then anything left over, of course, have some savings for your expenses, and then the rest of it you can just invest or like enjoy life. I don't know.
Yep.
Of course, but yes, you want to invest. So again, no recommendation to buy or sell anything that we're going to mention here. We just want to share, this 3-fund portfolio because it's quite a famous thing. People who follow this strategy are called Bogleheads.
Bogleheads.
Yeah.
Yeah.
So they just do, instead of like finding stocks for themselves. Some people just don't enjoy that.
Yeah.
I just do ETFs when just 1, 2, and 3.
People who don't really have time at all to even listen to this podcast roundtable, they should listen to this strategy.
Okay.
But they won't be listening.
Because they just focus on that, right? Yeah. So, who would you recommend this kind of strategy to?
Yeah.
Like you said, this
The
kind
people who
of
are very busy, don't have time to
Do you
watch
know of
this
anyone
roundtable.
who you follows this?
I teach that to some of my friends.
Okay.
Right? They don't have time to stock pick, so they, but they do in the S&P 500. Right? I told them that because I didn't know about the VWRA, the Irish domicile.
Okay.
So, but they already do it for many years, so they didn't want to, switch and.
But
Yeah.
even if you have time to do stock picking and all that, I would suggest that you allocate a portion of it for that ETF investing also, right? Just to go for the market rate return.
Okay.
Yeah, but then of course it depends on how much passion you have or how much return that you are expecting to get, right? Then you should allocate accordingly. If you are more into like stock picking, you want to achieve or focus on great companies, then obviously you can go for those stock picking, right? Yeah, but for a lot of people, it's not easy to beat the market. So I think ETF strategy really still makes a lot of sense. Yeah, for most people.
All right.
Yeah, whether you do stock picking or not.
All right. And again, we have to invest globally,
Yep.
Yeah.
not just because you're from Singapore, you invest
Yeah.
in Singapore.
Yeah.
Because everything
Anything
is
that happen in global will happen in Singapore.
So just-
affected Singapore affected. Yeah.
So in fact, this 3-fund portfolio for some people theoretically in Singapore can just be a 1-fund portfolio.
Yep.
Yeah.
You just VWRA,
Yep.
and then the rest of it, CPF is kind of like automatic.
Yeah.
If you're drawing a salary,
This-
and you just focus on that for like 20, 30 years.
Correct.
Yeah.
Hopefully, at the end of the day,
The
you're ahead.
laziest way to invest is using this strategy.
Yeah.
I don't expect huge return.
Yeah, I mean,
Market
market
returns,
returns,
market
basically.
which is
no,
pretty
actually, it's
good.
less than market return
Because
because you
of-
don't get exact to the.
Yeah,
that's
yeah.
why I show you
Yes,
the exact, but plus the fee plus the expense ratio, it should be slightly lower.
Yeah. But this market returns basically.
Yeah.
Yeah. Okay, so I mean, for those who are watching this, they looking for a passive way to invest.
Yep.
They don't want to like think too much about this. This is one way you can consider it. So Victor was saying VWRA,
Yep.
or some version of S&P 500 like CSPX, and
Yep.
you have
SWDA, which is
SWA.
iShare Core MSCI World
All right.
ETF.
So many flavors of ETFs out there. You just pick the one that you like, and of course, CPF. Some people, have their they don't want to put money in the CPF because they only get it at 55. But I think it's a very good way to just earn 4% risk free. I don't think you can find a similar bond fund out there actually, something like that. Yeah, hard to
That's
find.
backed by government.
Yeah, AAA rated and all that. All right, so we just wanted to share this very three fund, easy way to invest, three fund portfolio by John Bogle, who's the founder of Vanguard, ETFs and low cost ETFs. And that's pretty much it, right, guys?
Yep.
Yeah.
All right. So my name is Adam. That is Rusmin, Victor.
Thank you.
Any questions about this three fund portfolio thing? Feel free to ask them, share your comments and stuff. Any other ETFs that you consider? Of course, like this roundtable, and it really help us with the algorithm. Of course, subscribe to our channel. Many more roundtables coming up, and we'll see you again.